Stop whatever you are doing, because what you are about to hear is not financial speculation, not academic theory, and not the kind of economic forecasting that gets revised by morning. 8 months ago, the prediction was made with surgical precision. The Eurozone, that grand experiment in monetary union without fiscal integration, was entering its terminal phase. The specific timeline was provided. The exact sequence of sovereign defaults was mapped. The mathematical inevitability of cascade failure was demonstrated using debt to GDP trajectories that anyone with access to Eurostat data could verify, but that somehow every central banker in Frankfurt chose to ignore. Tonight, that prediction is no longer prediction. It is unfolding reality captured in real-time bond spreads, liquidity ratios, and interbank lending freeze patterns that mirror 2008 with terrifying precision. Greece has just missed a scheduled debt service payment to the European Central Bank, not officially, not publicly, not in any way that triggers formal default declarations, but through an accounting maneuver so transparent that every sovereign debt trader in London recognized it instantly for what it actually represents. Italy's 10-year bond yields have crossed the 7% threshold that historically marks the point of no return for Eurozone member states. Spain's regional governments have begun informal discussions with Beijing about yuan-denominated credit facilities that would effectively constitute withdrawal from European monetary discipline. En Paris. Portugal's banking sector is experiencing deposit flight at rates exceeding 15% monthly, a velocity of capital evacuation that no lender of last resort mechanism can sustainably counter. The number that matters tonight is not any single data point, but rather the convergence of 4 separate indicators that together form what can only be described as a mathematical proof of systemic collapse. Eurozone aggregate M2 money supply has contracted by 8.3% year over year, a monetary compression exceeded in modern European history only during the Great Depression. Target 2 imbalances, those obscure but absolutely critical intercentral bank settlement positions, have reached 1.2 trillion euros, with Germany's Bundesbank holding claims against peripheral nation central banks that will never, under any realistic scenario, be repaid in full value. Corporate lending in the Eurozone has declined for 11 consecutive months, not because businesses lack investment opportunities, but because banks are hoarding liquidity in anticipation of sovereign restructuring events they know are inevitable. Youth unemployment across the southern European periphery has reached 42%, a figure that represents not merely economic hardship, but the complete destruction of an entire generation's productive capacity and the political radicalization that historically follows such devastation. If this analysis has been cutting through the official narratives from European Commission press releases and the sanitized assessments from mainstream financial media, this is the moment to ensure you never miss an update. Subscribe to this channel, activate notifications, and share this analysis with everyone in your network who needs to understand what is actually happening in the architecture of European finance before their own portfolios, their own retirement accounts, their own economic futures are consumed by a crisis that officials will continue denying until the morning it becomes undeniable. The prediction made 8 months ago was not based on ideological preference or geopolitical wishful thinking. It was based on mathematical analysis of sovereign debt sustainability under conditions of monetary union without fiscal transfer mechanisms, combined with demographic trajectories that make current welfare state obligations arithmetically impossible to sustain, further complicated by energy cost structures that have permanently destroyed European industrial competitiveness. The specific prediction provided an exact sequence of defaults. Greece would be first, not because Greek debt levels are the highest in absolute terms, but because Greek debt is held primarily by European institutions that can most easily absorb restructuring through accounting measures that avoid formal default declarations. Italy would follow, not immediately, but after a 6 to 9 month period, during which European Central Bank bond purchases attempt to suppress yields through market intervention that ultimately proves insufficient against the mathematical reality of debt dynamics. Spain would be third, triggered not by central government default, but by regional government failures in Catalonia or Valencia that create constitutional crises preventing coherent national fiscal response. Portugal would default fourth, quickly following Spain as contagion spreads through interconnected banking exposure. France, the economy that European officials believe is too systemically important to fail, would face sovereign debt crisis last, but most catastrophically, because French default would represent the definitive end of the euro as a functioning currency system. That sequence is now unfolding exactly as predicted, not in dramatic single-day crashes that make headlines, but through the gradual accumulation of technical indicators that professional fixed-income traders recognize as precursors to formal restructuring events. Greek bond spreads versus German bonds have widened to levels that price in 70% probability of restructuring within 18 months. Italian banks have begun moving headquarters to Luxembourg and Dublin in preparations that indicate institutional anticipation of sovereign event risk. Spanish regional governments are issuing debt with yields 400 basis points above comparable German lender obligations, a spread that reflects market perception of actual default probability rather than liquidity premium. Portuguese pension funds have begun liquidating domestic sovereign holdings in favor of German and Dutch government paper, a capital flight pattern that becomes self-fulfilling as selling pressure drives yields higher and makes the underlying debt less sustainable. The technical architecture of the Eurozone makes this crisis fundamentally different from standard emerging market debt situations and far more dangerous to the global financial system. Eurozone member states cannot devalue their currencies to restore competitiveness because they do not control their currencies. They cannot monetize their debts directly because they do not control their central banks. They cannot implement capital controls to prevent deposit flight because European Union law prohibits such measures. They cannot restructure their debts unilaterally without triggering cross-default clauses that would cascade through the entire European banking system. The only tools available are fiscal austerity, which destroys growth and makes debt less sustainable, or official sector bailouts, which transfer liabilities from peripheral nations to core nations without actually reducing aggregate European debt levels. This structural trap was predicted 8 months ago with complete precision. The argument presented then was straightforward. European monetary union was designed with the assumption that fiscal discipline would be maintained through political commitment and that sovereign debt crises would not occur because markets would enforce discipline through yield spreads. Both assumptions have proven catastrophically wrong. Political commitment to fiscal discipline evaporated the moment that discipline required actual sacrifice rather than theoretical agreement. Markets failed to enforce discipline during the low interest rate period before 2022 and are now enforcing discipline so violently that yields have risen beyond sustainable levels. The result is a monetary union where peripheral members cannot survive within the euro but cannot exit the euro without destroying their banking systems through deposit flight and currency redenomination chaos. Germany faces an impossible choice that was predicted in exact detail 8 months ago. Option 1 is to accept fiscal transfers to peripheral nations on a scale that would require German taxpayers to permanently subsidize consumption in southern Europe at levels politically impossible to sustain. Option 2 is to allow peripheral defaults and euro exit, which would cause the euro to appreciate sharply against new peripheral currencies, destroying German export competitiveness and triggering German recession. Option 3 is to dissolve the euro entirely and return to national currencies, which would require Germany to redenominate trillions of euros of debt and liabilities with consequences impossible to model. Every option leads to economic contraction and political crisis. There are no good choices remaining, only choices between different forms of severe damage. The bond markets are now pricing these realities with brutal efficiency. Italian 10-year yields at 7.4% represent a debt service burden that consumes 23% of government revenue at current outstanding debt levels. That percentage is mathematically unsustainable, given that Italy already runs primary deficits before interest expenses and faces demographic decline that will shrink the tax base by 18% over the next 15 years. Spanish yields at 6.1%, combined with regional government debt loads, mean that total Spanish public sector debt service will exceed 30% of combined central and regional government revenue within 2 fiscal years. Portuguese yields at 6.8% against a debt-to-GDP ratio of 132% create a debt dynamic where the outstanding stock grows faster than nominal GDP under any realistic growth assumption. Greece represents the most immediate flashpoint because Greek debt restructuring can be accomplished through European institutional creditor forbearance without triggering widespread contagion, creating a template for subsequent peripheral restructurings. The missed debt service payment that occurred this week was technically described as a maturity extension agreed agreed between the Greek government and European Financial Stability Facility, but the economic substance is identical to default. Greece received funds in the past, committed to repayment on specified terms, and is now changing those terms unilaterally because the original terms are no longer sustainable. This is the definition of restructuring, regardless of the diplomatic language employed to describe it. Italy represents the point where restructuring becomes systemic crisis, because Italian debt is held not primarily by official European creditors, but by Italian banks, Italian pension funds, and global institutional investors who cannot be coerced into accepting restructuring through political pressure. Italian banks hold over 400 billion euros of Italian sovereign debt on their balance sheets. Italian pension funds hold over 300 billion. When Italian yields rise above 7%, these holdings suffer mark-to-market losses that exceed bank capital buffers and pension fund reserve requirements. The losses force asset sales, which drive yields higher, which cause further losses, creating a doom loop that has no market-based exit mechanism. The energy dimension of this crisis amplifies every other factor because European industrial competitiveness has been permanently destroyed by natural gas prices that are now structurally 4 to 5 times higher than American prices and 2 to 3 times higher than Asian prices. European chemical manufacturers, steel producers, fertilizer plants, and other energy-intensive industries cannot compete at these cost structures. Production is being shut down permanently, not temporarily. The industrial base that generated the tax revenue to service sovereign debt is disappearing. Germany, the industrial core that was supposed to fund peripheral consumption through Target 2 credits, is deindustrializing. The factory closures are not cyclical adjustments. They are permanent relocations to North America and Asia, where energy costs allow profitable operation. The political consequences of this economic disintegration are creating governance crises that make coherent policy response impossible. Italy has had 5 different governments in the past 7 years, each pursuing contradictory fiscal and structural reform policies that prevent any consistent adjustment strategy. Spain faces Catalan separatism that could trigger constitutional crisis and regional debt repudiation. France is experiencing social unrest on a scale that prevents implementation of pension reforms necessary to reduce long-term fiscal burdens. Germany's governing coalition is fracturing over energy policy and fiscal transfer questions. The European Union lacks the political cohesion to implement the fiscal integration that might theoretically stabilize the monetary union, while individual member states lack the tools to address crises independently. This was all predicted 8 months ago, with complete specificity, not as one possible scenario among many, but as the mathematically inevitable outcome of debt dynamics combined with demographic decline, combined with energy cost structure, combined with monetary union design flaws. The prediction was not believed by European officials because acknowledging it would require admitting that the entire European project as currently designed is failing. The prediction was not believed by mainstream financial analysts because it contradicted the consensus that somehow central bank intervention could indefinitely postpone sovereign debt mathematics. The prediction was not believed by political leaders because accepting it would require political choices that no democratic politician could survive making. Tonight, the prediction is no longer prediction. It is current reality visible in every bond screen, every interbank lending report, every capital flow analysis. Greece has effectively defaulted through restructuring labeled as maturity extension. Italy is approaching the yield levels that make default inevitable within 12 to 18 months. Spain is experiencing the early stages of regional debt crisis that will metastasize to sovereign level. Portugal is suffering deposit flight that will force either capital controls or banking collapse. France is discovering that being too big to fail does not mean too big to face debt crisis, only too big to be resolved through existing mechanism. The sequence is unfolding exactly as mapped. The timeline is proving accurate. The mathematical models are performing as predicted. This is not vindication. This is tragedy. Hundreds of millions of Europeans are about to experience economic devastation that will destroy living standards, consume savings, eliminate retirement security, and create political radicalization that will reshape the continent for generations. The crisis was preventable through honest recognition of Eurozone design flaws and serious fiscal integration or orderly dissolution. Instead, officials chose denial, delay, and extend and pretend policies that have made the eventual crisis far more severe than necessary. If you want analysis that identifies these structural failures before they become undeniable, that maps the crisis trajectories while intervention is still theoretically possible, that refuses to accept official narratives over mathematical reality, subscribe to this channel now. The European sovereign debt crisis is entering its acute phase. The defaults are beginning. The sequence is locked in. Understanding what happens next, which banks fail, which nations exit the euro, which political systems fracture, which alliances dissolve, requires analysis willing to follow the mathematics regardless of where it leads. The world is watching a monetary union die in real time. The predictions made 8 months ago are becoming the financial history being written tonight. Every percentage point of yield increase, every billion of deposit flight, every basis point of spread widening confirms the analysis that officials dismissed as alarmist. The meltdown is here. The defaults are beginning. The only question remaining is whether anyone in Brussels will admit the truth before the entire structure collapses completely, or whether denial will persist until the morning that denial becomes impossible. History suggests the latter. Mathematics guarantees the outcome. The timeline is now.